The US dollar is not losing global dominance because of politics, sanctions, or headlines. It is losing dominance because $35 trillion of debt has broken the mathematics of trust. Foreign central banks are selling US Treasuries. Gold purchases are hitting all-time records. America's interest payments now exceed its military budget, and deficits are no longer cyclical. They are permanent. This is not normal, and it is not temporary. What this actually means is far more serious than most people realize. The global monetary system is flashing the same warning signals that have appeared before every major currency collapse in recorded history. This video explains why America's debt trajectory is not just unsustainable, but historically terminal, and why the erosion of the dollar's global role is not speculation, not ideology, and not a future risk. It is a pattern already in motion. History doesn't repeat, but it rhymes. And every reserve currency that ignored this pattern ended the same way. History shows that no reserve currency lasts forever. Not because of incompetence, not because of corruption, but because the structure of debt-based monetary systems inevitably collides with political reality. Empires do not fall when they are weak. They fall after periods of extraordinary strength, expansion, and confidence when spending commitments exceed the discipline of sound money. This pattern appears across centuries, continents, and political systems. And once you see it clearly, today's events stop looking random. They look inevitable. Let's start where modern monetary history begins. Rome does not collapse overnight. It erodes. In the early Roman Republic, the silver denarius is nearly pure, close to 100% silver by weight. Trust in the currency is absolute because the money itself contains value. The state cannot spend more than it can tax or mine. But empire is expensive. By the reign of Emperor Nero in the 1st century AD, Rome begins quietly reducing the silver content of its coins. What begins as a marginal adjustment accelerates over time. By the 3rd century, under emperors like Gallienus, the denarius contains less than 5% silver. The result is predictable. Prices rise. Confidence erodes. Citizens hoard older coins and reject new ones. Diocletian attempts price controls in AD 301. They fail catastrophically. Trade reverts to barter. Taxation becomes coercive. The monetary system fractures, and with it, Rome's ability to govern a complex empire. Homie does not run out of money, it destroys it. Fast forward to post-World War I Germany. The country is buried under reparations, domestic debt, and political instability. The solution is not spending cuts or restructuring, it is printing. In 1921, inflation accelerates. By 1922, it becomes exponential. By late 1923, prices double every few days. Workers are paid twice daily so they can spend wages before they lose value. Wheelbarrows of banknotes buy a loaf of bread. Savings are obliterated. But something remarkable happens beneath the chaos. Those holding gold, silver, or foreign hard currency preserve wealth. Those holding paper promises are wiped out. This is not an accident. It is the mathematical consequence of monetizing debt beyond public confidence. For over a century, the British pound is the world's reserve currency. That status is earned through trade dominance, financial discipline, and gold. But 2 world wars change everything. By 1945, Britain is heavily indebted to the United States. The pound is weakened. Capital controls proliferate. Sterling struggles to maintain parity. In 1967, the UK officially devalues the pound by 14%. It is an admission, not a solution. Reserve status quietly shifts to the US dollar. Britain does not collapse, but its monetary dominance never returns. Reserve status is lost not in a single event, but through cumulative credibility erosion. Reserve status is lost not in a single event, but through cumulative credibility erosion. The modern era begins on August 10th, 1971. Facing massive deficits from the Vietnam War and domestic spending, the United States closes the gold window. Foreign governments can no longer redeem dollars for gold. The constraint disappears overnight. What follows is 5 decades of accelerating debt, expanding deficits, and financialization. Growth appears strong, but it is increasingly. This moment creates the pure fiat system we live in today, and it sets the clock. Every one of these collapses follows the same sequence, and that sequence is repeating right now. Stage 1. Sound money. Every monetary system begins with restraint. Sound money is backed by something scarce, gold, silver, or an enforceable claim on real assets. The supply cannot be expanded at will. Governments must tax honestly or borrow cautiously. This stage feels stable, prosperous, predictable. Rome's early denarius, Britain's gold-backed pound. The original Bretton Woods system. The constraint creates trust, and trust enables trade, investment, and empire. But sound money contains a paradox. It limits political ambition. Stage 2, debt expansion and debasement. Then comes pressure, wars, welfare, promises, imperial overreach. The temptation is always the same. Relax the constraint, debase the coin, break the peg, print the currency. At first, it works. Growth accelerates, markets rise, pain is deferred, politicians are rewarded, but debt compounds and debasement accelerates. Rome clips, coins, Weimar prints. America abandons gold. The math does not forgive. Stage 3, inflation and loss of confidence. This is where the United States is right now. Deficits never reverse. Debt grows faster than GDP. Interest costs compound. Foreign holders reduce exposure. Inflation becomes structural, not cyclical. Rate hikes slow demand but cannot solve solvency. This stage can last years, even decades, but it always ends the same way. Confidence breaks. Stage 4, collapse and revaluation. Collapse is not cinematic. It is gradual, then sudden. Assets reprice. Currencies reset. New systems emerge. Those holding real assets survive. Those holding promises do not. History is unambiguous. So where are we today? Let's look at the data. So where are we today? To answer that question, we do not need speculation. We need arithmetic, we need incentives, and we need to observe behavior, not rhetoric. Every currency collapse in history leaves behind the same fingerprints, and those fingerprints are now visible across U.S. debt metrics, Chinese strategic behavior, precious metals markets, and institutional positioning. Let's examine them one by one. U.S. debt trajectory. The irreversible math, the United States now carries over $35 trillion in federal debt. Annual deficits exceed $2 trillion, even outside recessions. The D-to-GDP ratio has surpassed 125%, meaning total obligations are now far larger than the productive output of the economy itself. But the most dangerous number is not the total debt. It is the interest. Annual interest payments are now above $1 trillion per year. That is more than the U.S. defense budget. And unlike discretionary spending, interest cannot be cut, postponed, or negotiated. This is where the system locks. To service the debt, the Treasury must issue more debt. To absorb that debt, markets require higher yields. Higher yields increase interest costs, which require even more borrowing. This is not policy failure. This is exponential mathematics. America is now adding roughly $70,000 of debt every second. By the time this video ends, the national balance sheet will be millions of dollars deeper into a hole that cannot be filled by growth alone. Historically, this exact configuration marks Stage 3, China's strategic moves, silent de-dollarization, while headlines focus on tariffs and trade disputes. The real story is happening quietly in balance sheets. China once held over $1.3 trillion in U.S. Treasuries in the early 2010s. Today, that figure has fallen to roughly $770 billion, the lowest level in more than a decade. This is not random diversification. At the same time, China has been aggressively accumulating gold, adding hundreds of tons to official reserves over the past several years. Independent estimates suggest the actual holdings may be significantly higher than reported. China is also building parallel financial infrastructure. The CIPS payment system reduces reliance on SWIFT. The Enbridge project facilitates cross-border settlement outside the dollar. The Belt and Road Initiative denominates trade in local currencies and commodities. This is not an attack. It is on exit. Historically, reserve currency transitions do not begin with collapse. They begin with quiet preparation by rival powers who recognize Stage 3 before the public does. Precious metals market signals. Confidence under stress. When confidence weakens, money moves first. Central banks are now buying over 1,000 tons of gold per year, the highest levels on record. This is not retail speculation. It is sovereign risk management. Silver markets are flashing even louder warnings. Industrial demand from solar, electric vehicles, and electronics is hitting historic highs. At the same time, supply deficits are emerging, with hundreds of millions of ounces more demanded than mined annually. Government mints report delivery delays, inventories tighten, premiums rise even when paper prices stall. History is clear on this signal. When mints struggle to meet demand, it is not about metal. It is about trust, institutional behavior, what smart money is doing. While public narratives emphasize resilience, institutional behavior tells a different story. Major asset managers expanded exposure to China even during trade tensions. Sovereign wealth funds increased allocations to commodities and real assets. Long-duration government bonds have quietly fallen out of favor. Warren Buffett holds record cash levels not because he expects opportunity tomorrow, but because volatility precedes repricing. Wall Street does not make moral judgments. It follows incentives, and incentives are now shifting away from long-term dollar promises toward tangible, productive value. This is not speculation. Every data point confirms we are in stage 3, and history shows stage 3 never reverses. It only accelerates towards stage 4. Once stage 3 begins, the outcome is no longer a question of policy. It is a question of time. Debt grows exponentially. Confidence erodes linearly until it breaks suddenly. No reserve currency in history has escaped this phase through a reform alone. Not homie, not Britain, the US dollar is not exempt because it is dominant. Dominance is what allows the imbalance to grow this large. Could this take 5 years? Yes. Could it take 15? Also, yes. Reserve currency status decays slowly until it doesn't. What accelerates collapse? Geopolitical shocks, debt spirals, confidence breaks. What delays it? Network effects, military power, inertia. But direction matters more than speed. And the direction is set. This is not about fear. It is about preparation. History shows that during monetary transitions, wealth concentrates around productive assets, hard money, essential commodities, and knowledge. What consistently loses value? Long-term government bonds, cash savings, fixed pensions. This is not ideology. It is historical precedent. This is not a prediction. This is pattern recognition based on 2,000 years of monetary history. The pattern does not change. Only those who recognize it early have options. Every monetary system follows the same 4 stages. Stage 1 builds trust through restraints. Stage 2 breaks restraint through debt. Stage 3 erodes confidence through inflation. Stage 4 resets the system through revaluation. The United States is now in stage 3. History shows what comes next. If you want to understand how this system was built, who benefits from it, and how historical transitions actually play out during stage 4, subscribe for the next breakdown.